Welcome to the Life Self-Mastery Podcast, where we bring in entrepreneurs who have created online businesses and improved their lifestyles. Here's your host, Rohit Malhotra.
Hi everyone, this is Rohit from Life Self-Mastery, and today I'm excited to have Fabrice Grinda, who's a founder of startup studio and venture fund FJ Labs, which he co-founded with his business partner Jose Marin. Fabrice has more than 150 exits on 500 angel investments. Fabrice has served as CEO for 3 multinational companies and has an impressive track record as an early investor in Alibaba, Flexport, Zume Pizza, Delivery Hero, and others. Prior to FJ Labs, Fabrice was co-founder and CEO of OLX, one of the largest websites in the world with over 300 million unique visitors per month. The company operates in 30 countries and has over 5,000 employees. Fabrice holds a BA in economics from Princeton University. Welcome to the show, Fabrice.
Thank you for having me.
Awesome. So, how did you get into this crazy world of startups and venture capital?
Well, I guess getting into startups really came out of what was a hobby of mine. In the 1980s, I got my first PC when I was 10 in 1984, and I started building computers and assembling them and learned to program. I ran a BBS, or bulletin board service, in the pre-internet days, and was really following what was going on with Microsoft and Apple, so Bill Gates and Steve Jobs. And I knew I wanted to be in the tech sector in some way, shape, or form. And then went to Princeton in 92, studied economics and math mostly because I didn't feel I needed to learn anything else in the computer sphere. And lo and behold, the internet bubble started coming to the fore and exploding. That said, at that time, when I graduated, I was 21. I didn't really understand anything. I'd never managed people. I didn't really know business. I'm like, even though I want to be a tech entrepreneur in the future, it's good for me to go and learn the basics of business. So I went to McKinsey & Company as a consultant in New York for 2 years, 96, 97, 98. I thought actually doing so I might miss the bubble, but lo and behold, I didn't. And so in 98, I left McKinsey and I built my first startup. And basically it's gone on from there. Now on the venture side, kind of happened by happenstance. I mean, when you're a consumer-facing internet CEO and you're rather visible, a lot of other entrepreneurs are asking for money. And so I became an angel investor pretty much in 1998 when I started building companies. And for the next 15 years, essentially, as I was building companies, I kept angel investing. And when I sold OLX in 2013, or when I left OLX at least in 2013, I'd already made over 100 angel investments. And I'm like, you know what? I like building companies. I like investing in companies. Let's create a structure or holding company to keep doing that, which is the genesis of FJ Labs. But I actually never thought I would be building a venture fund per se. It was just investing personal capital. But then little by little, a number of strategic investors said, hey, what you guys are doing is interesting, and it's interesting to us. We'd love to invest alongside you guys to get a knowledge and expertise in the marketplace space, which is my specialty. And so in 2016, we built our first fund with 15 million of external capital, and then in 2018 we built our second fund, and we were off to the races.
Interesting. And you've been a part of building companies like Zingy and OLX. What were some of the biggest learnings from raising capital and building companies and getting an exit out of Zingy and OLX?
Well, very different learnings in terms of building the businesses, and also very different learnings in terms of raising capital. Raising money, there's an X factor. Clearly, VCs, I put myself differently in the shoes of a venture capitalist today, an investor. What is it that I look for in an entrepreneur? And usually it's 4 things, and I'll just go high level. It's like extraordinary storytelling skills and analytical skills in the team, so an amazing team. Number 2, a great business per se, which means great unit economics. I want them to recoup their customer acquisition costs in 6 months and to 3x their customer acquisition costs in 18 months. 3, reasonable deal terms, and 4, something that fits my thesis. But then that X factor is the idea you're doing in line with what the world is looking for at that point in time? And it just so happened that in the 1998, when I was building my first company, which was an eBay for Southern Europe, the pedigree, like the bubble was it was really an internet bubble. I mean, because I had the right pedigree, like McKinsey, Princeton, et cetera, people were throwing money at me. I was 23. I really didn't know what I was doing. And I managed to raise like 63 million in venture money. After the bubble exploded in 2001, even though I'd built a company that made a lot of sense, was capital efficient, had great unit economics, it was impossible to raise a single dollar. So 2001, 2002, 2003, as I was doing BDC telecom in a way, I don't think I'd finished the sentence talking to a VC that they hung up. Like there was no way to raise a single dollar. And so I invested every last penny I had. I borrowed on my credit cards. I tapped out all my friends and family to raise like in 5K or 10K increments. I missed payroll like 27 times. I had to live in New York in the office, couldn't even afford coffee, basically living off of ramen noodles. And we're starting to attract investor interest only after it became profitable, which of course was no longer necessary. So I sold that company. But then the next company, because investors had missed out on investing in Zingy and making a lot of money, all of a sudden VCs are throwing money at me all over again. It's like, oh, whatever you do, we'll fund you. And so I built OLX. We started from the get-go raising 10 million at a 28 million valuation, like with just on a PowerPoint based on a dream. And so the funding raising environment matters a lot, right? Today, if you're trying to build a company today, you need to raise money in the middle of like the COVID pandemic. It's extraordinarily hard to raise capital, but at the same time, it's really an amazing time to be an entrepreneur and to raise money, and because the opportunity cost is decreased and you're facing less competition. So in terms of lessons learned, so fundraising, there's this X factor of like, are you hitting the zeitgeist, or are you in the macro at the right time in the macro, or people looking for something that what you're building, and of course, do you meet the requirements? And there are a lot of lessons learned in terms of like run an effective process, make sure that all the people you're talking to are more or less at the same stage at the same time, and also be in line with the expectations of venture capitalists, right? Like, so if you're talking to seed stage VC, you need to have the seed stage level traction and expectations of valuation and fundraising. Same thing at the A and same thing at the B. Now, in terms of lessons learned writ large, in terms of building a company, there's so many of them in the sense that I made mistakes hiring the wrong type of people. I made mistakes keeping them on too long. I made mistakes, I launched a company that ultimately had a massive component of SEO. I didn't even know what SEO was, and that was OLX when we first created it in early 2006. And so the issue is not making mistakes. You will make mistakes operating. It's just react and be decisive, throw a lot of spaghetti on the wall and adjust accordingly.
Got it. And you've been an angel investor, and then you went on to be a VC. How do you think the investment mentality is impacted from the shift from being an angel investor to be a VC?
I think for most people, it'd be a pretty different experience because an angel investor, you're a passive investor, you're writing 50K checks, you're not doing due diligence, you're not the lead. And most VCs, it's the opposite. They make concentrated bets in companies. They take the lead, they take a board seat, and they're much more involved. In my case, it wasn't a very big transition at all because I decided I want to be a VC that acted like an angel. So we're never leading. We're always co-investing with the major VCs, and there's a few reasons for that. But one of the main reasons is we want to be their friends, a value-added investor, and not a competitor. We're not fighting for allocation. And so, if Sequoia or Accel is writing a check, I want them to say, "Hey, Fabrice knows a lot about this category. He can help the entrepreneur. I should bring him in." And if they're investing 7 million, we'll invest 500K or 700K. So in our case, or in my case, moving from an angel to VC didn't really change anything. We still don't, we decide very quickly, like 2 1-hour meetings over a 1-week period, and we say yes or no, and we say why. We have full transparency on investment processes. We're still super prolific. I mean, last year we invested in 124 startups. We have almost 600 companies in the portfolio. So the approach hasn't really changed. I mean, we're still acting like super angels rather than proper venture capitalists, even though we're deploying like 50+ million a year.
Got it. And as you mentioned, you've invested in 124 startups last year. So, what is the investment thesis, and how do you look at portfolio construction for FJ Labs?
So again, we're not a normal VC because we don't look at portfolio construction. So most VCs are like, oh, we're whatever. I want my fund to have 10 Series A companies and I'm keeping money for follow-ons, et cetera. It's more, we don't actually have a set ratio of like, do we want seed, pre-seed, A, B, C, Europe, US, India, Brazil. It's more, we see companies. If we like the company, we invest. If we don't like the company, we don't invest. And then we see what happens. And it just so happens the portfolio right now is about 65% seed pre-seed, 25% A and B, 10% later stage, and it's 70% US and Canada, 20% Western Europe and the Nordics, and 10% Brazil and India. But it's not because we constructed it that way. Also, we have a very different philosophy on follow-ons. We don't actually keep capital for follow-ons. So if Fund 1 invested and we ran out of money in Fund 1, because we deployed everything, we'll invest. If we decide to do a follow-on, and we only do it 25% of the case, because we only do it if we think basically we evaluate the follow-ons as though we were not existing investors. Then we're like, okay, based on what we know about the founders and the team and the traction and the deal terms, would we want to invest in it? The answer is yes. We do our follow-on. If not, we don't. But if we do it, very often it comes from the next fund, which is not at all the way traditional VCs work. So we actually do not have portfolio construction or portfolio construction theory. We tell people, if you invest with us, you should invest in every fund. This way you get exposure to everything we do. And you don't need to think through, and we're not trying to overthink portfolio construction. We don't have institutional investors. If I go to institutional investors and I tell them, I'll invest at every stage, in every geography, in every industry, we don't do due diligence and we don't take board seats. I don't think I finished the sentence that I've already died in a heart attack. Yet our performance is like top 1% of all VCs ever, because actually our flexibility has allowed us to move stage or geography based on where we see opportunity. There are periods where it's better to be at seed. There are periods where it's better to be at pre-seed or seed extension or A. There are periods where, like 10 years ago, Brazil, Turkey, and Russia were probably 50% of our investments. And then after the geopolitical changes, we brought that almost to zero. And then only recently started investing in Brazil again. India wasn't part of our thesis. We added India. And so that flexibility, I think, has been very beneficial to us, but is very, very non-traditional, and explains why we don't have like pension funds or university endowments as investors. Nor do I want the structure. I mean, the virtue of not leading means there's a maximum check size I can write, right? If a seed round is like 3 million and the lead is putting 1.5 million, I can't really invest more than 500K. Otherwise, I start being a signal in the round and having too much ownership. So we don't have ownership requirements. I mean, we're really fundamentally different.
Got it. And you've been long on marketplaces, which can be harder to build upfront, but easier to scale. But what is your thesis of how do you look at marketplaces, and what does a founder needs to do to build a marketplace in 2020?
Sure. So I love marketplaces because they bring liquidity and transparency to otherwise opaque and fragmented markets. And right now, there are 3 theses we're focusing on marketplaces. One is the continued verticalization of horizontal marketplaces. So a horizontal marketplace is a marketplace that is in multiple categories. So Bazi or eBay India or OLX is a horizontal, but frankly, Uber Eats is a horizontal. They're in multiple food categories. Or the same thing is true of Thumbtack or Angie's List in the home services category. And so there's already been a very big trend of these companies being verticalized, but that's continuing. And it's not only continuing in the core product categories of OLX and eBay, but it's also happening in all the other categories. So in the US, for instance, we're investors in a company called Slice, which is a pizza online app, food delivery company, and they're doing really, really well for a variety of reasons I'm happy to talk about later. Second big thesis is for services marketplace, changing from one where you need to talk to the buyer and the seller need to talk to one where the marketplace picks your supply. So if you're driving an Ola or an Uber, you want to go from point A to point B, you just say that. You don't pick your driver. And our thesis is that this selection that we do on behalf of the client, we can do in every category. If you're an employer and you want to hire a programmer, instead of going to Upwork and saying, I need a PHP developer, we just say, this is the developer for you. And the same thing is true for an SEO person or SEM person in marketing. And there's a lot of these types of vertical marketplaces that we're building in the labor space and the services space. And then the third big thesis on a marketplace perspective is B2B marketplaces. So there's been this revolution in the consumer space with extraordinary user experiences coming out of things like Uber or Facebook or Google, but in many ways, the B2B space lags behind, and most of the transactions are happening based on relationships, on Rolodex, on email, on Excel, and they haven't been brought to the online world. And so we're investing either in marketplaces in a specific category, so we're in Node, a petrochemicals marketplace, or in the supply chain of the category. So for instance, we're investors in RigUp, which is an oil services company that provides labor to oil services companies, for instance, welders for a week. And these are the three core theses that we've been looking at. Now, to answer your second part of your question, which is, how does one go about building a marketplace today? Most marketplaces are demand constrained because the suppliers are financially motivated to be on the platform. So we focus as founders, entrepreneurs, or as investors telling our companies to do on the supply side. We say but it's very easy to get infinite supply. You don't want to do that. You want very curated, highest quality supply that are going to delight their customers, and you want to bring them great customers who are going to represent a fair amount of their revenues. So ideally, you should represent at least 25% of their revenues, ideally 100%, but to start with, of your supply. And you really want to scale supply and demand and match them very effectively such that you don't have a lot of supply that's not getting any work, otherwise they're going to churn, and they're high quality enough that your demand side is going to be very happy. And that usually means you start hyper-local in a neighborhood or in a city and in one very specific category, and then you scale from there.
Got it. I remember at Oyo Rooms also, we constrained ourselves to one geography, and then we went on to scale to other cities and other countries. But how are different ways you can drive supply and demand for marketplaces?
Well, it really depends on the category, right? Like in some cases, you can just acquire them through Google or Facebook. In some categories, it warrants having a sales team. So if you have a reasonably short tail of demand side coming from large enterprise, you probably have an enterprise sales team. Sometimes you do, maybe to get the supply, you might do ads on LinkedIn if it's for labor or in the categories for jobs that those people follow on Facebook. And maybe if it's an SMB, you create marketing online that leads to inbound sale or inbound calls that then are converted by a sales team. So there are definitely a key set of channels. Which one is right for you depends on the segment you're going after. And frankly, at the end of the day, it's all about unit economics. Can you make your acquisition channel, your paid acquisition channel especially, work, and can you scale it? And as long as the answer is yes, you keep scaling and you're going to do great.
Got it. And other than marketplaces, are there any other sectors which you favor?
Not really. We're so broad otherwise, right? We're in every geography, in every stage, in every industry. The real focus is marketplaces. And the reason I like marketplaces is it unlocks a massive amount of value to create liquidity and transparency in opaque and fragmented markets. And also they're inherently scalable in the sense that once you have the flywheel going and ever more buyers brings in more sellers and more sellers bring in more buyers, it creates a massive barrier to entry. And they have a tendency as a result to become winner takes most, if not winner takes all. And they're much more compelling companies than traditional companies where you need a lot more capital, the barriers to entry are a lot lower, maybe you need to build a brand, and these things are less compelling to me than things that have fundamental network effects.
Got it. And are there any metrics which founders should hone on, and are there any metrics which they should disregard when they're looking at raising funds?
Well, a few things. So we, as I mentioned earlier, are unit economic focused. And so when you pitch us, regardless of stage, if you're pre-launch, it can be theoretical unit economics based on what the average order in the industry is and what you expect yours to be, and they better be aligned. And based on the tests you've done on customer acquisition costs. And as I said, we like businesses where you recoup your fully loaded customer acquisition costs on a net contribution margin basis, so CM2 basis, after 6 months at the latest. You 3x your CAC in 18 months, and ideally you have negative churn. So even though maybe 50% of your business, of your demand is churned, the remaining 50% are buying so much more that who knows what your CAC to LTV is. Maybe it's 10x, maybe it's 20x. So for us, that's absolutely fundamentally important. Now, when you go to raise money, you need to be aware that different investors, different stages have different set of expectations. So if you're pre-seed and you're just launching, okay, you don't need any metrics. When you're at seed, most of the companies talking to us, we expect them to have 100 to 200K a month in the US in GMV, and they take 10 to 20% of that. So their net revenues are going to be between 10 and 40K, let's say. When you're at Series A, most of the companies are going to be 500K and 1 million a month in GMV, again, taking 10 to 20%. And so they're going to have in net revenues 50K to 200K. And the margin on that net revenue, by the way, we expect them to have is like 60 or 70%. And so there is a pretty clear set of expectations for where people need to be in order to raise. And if you're trying to raise when you're not in these ranges, it's problematic. Actually, my current last blog post is what are the different expectations or ranges you need to be at to raise different rounds. And this way it's a good guideline for who you should be talking to.
Right, and we'll put that in the show notes as well. And we're recording this podcast in the month of April, and we're still in times of COVID-19. What would be your advice to founders on how they should look at funding, you raising the next round of funding, and what would be your advice for them to grow the business?
Well, for the most part, funding is completely dried up right now. So if you need to raise money right now, you're probably screwed. What we're telling all of our founders is really, and obviously it's a broad generalization. Some people are actually benefiting from this because they're in the remote workspace or they're in video games, et cetera. But for the most part, people are making sure that they either get a profitability or extend the runway for at least 18 to 24 months. And that has meant on average that many of the founders have cut their salary to zero. They've cut all of their staff salary by 30%. And they actually fired 30% of their team to really decrease burn. And then the only KPI that matters is profitability. Can we get a profitability? Can we narrow that? Can we become masters of our own destiny? Because the assumption is that cash is king, and potentially for a long time, no money is going to be coming. And no money is going to be coming for a number of reasons. A lot of people are risk off right now. But let's say the economy starts doing well again or better in Q3, Q4. Every single company that hasn't been raising is going to go out and try to raise that. It means the probability of raising is probably not going to be all that high in Q4 of 2020. And so making sure that you have cash to ideally raise in Q3 or Q4 2021 will put you in a lot stronger position. So most companies that in the easy times also had a fair amount of fat because they would use the extra cash in order to spend more on marketing than probably needed to in order to hide the fact that their growth wasn't as stellar as it could have been, or basically using this opportunity to trim down, make sure they focus on the core, make sure they get the basics right. If you just raised money before the crisis, you're probably in an amazing position right now because you're facing less competition, customer acquisition costs have gone down across the board, and you can still use this time to be opportune. If you raised 6 months ago, probably you can make enough cuts to actually extend your runway. It also depends which stage you're at. If you're an early stage company, seed stage company doing 100,000 a month in gross sales, but if you were taking 15% break, you're making 15% net, and you had a 66% margin. At the end of the day, it was only impacting your profitability by 10K. That goes to zero, it's not a big deal. You can probably find 10K of cuts to do in your cost structure reasonably easily. It's a much bigger issue at the later stage. A company doing 15 million or 20 million a month that was taking 20% and a 66% margin. If that goes to zero, they may have fired half their team and still have increased their losses dramatically. And so earlier stage companies in general are in a much better position, especially since the macro that really matters for them is the macro in 7 years or 10 years when they're exiting. And so we're still investing in the early stages as long as the companies are not in categories that are overly affected by this, like the event space, for instance, or, I mean, live events, and as long as they have enough cash for the next 18 to 24 months. Now, if you're thinking of becoming an entrepreneur today, I would argue this is the best time possible. There's going to be the opportunity cost in the sense that other jobs that are paying well or is decreasing because those jobs are most likely going away. You're not going to face all that much competition, especially if you're in a position to raise capital. And as a result, both direct customer acquisition costs from competitors are going to be lower because your CPCs are going to be lower. But frankly, the entire ecosystem is not advertising, and so CACs will be lower. You're going to be able to pay talent less. So be less competition to attract the best team, and it's going to be extraordinary. If you look back at the last crisis in 08, 09, the most interesting and startups of the last decade were all created in the last 2008, 2009 financial crisis. Uber, Airbnb, WhatsApp, Slack, all of them.
Correct. And again, I'm wondering, since you invest into so many companies in a year, how do you get the deal flow, so that you are able to deploy the capital in all these companies?
Well, in a way, we're very privileged. I mean, the beauty of having been an investor for the last 22 years is we're known as investors, especially in marketplaces. And so we have deal flow coming. We get about 100 deals a week, and they come in 3 different ways. A third comes directly to us inbound through LinkedIn or mostly LinkedIn, but frankly everywhere, Facebook, Instagram, whatever, or email. A third comes from entrepreneurs we've backed in the past. So in the past, because we invest in like 600 companies, it's like 1,500 entrepreneurs, and they come back with the next company. They send us their friends, they send us their employees who are becoming founders, and a third comes from VCs. Because we are not leading deals and we don't have a minimum check size, we're not competing for allocation with other VCs, and so we work with them. And all of our companies that are at seed need to go and get an A, or A needs a B, and frankly, even at the stage we're currently investing at, all those companies need a lead. And so we bring all these deals to our friendly VC partners. So we talk to 100 VCs every 6 to 8 weeks, and we share a deal flow with them. And so they send us deals, and we send them back deals. And those 3 channels work really well.
Right, and since you're not a conventional VC, how do you do you have LPs, and how do you deploy the capital? Is it your own personal capital which you're deploying there?
Yeah, so to date we've deployed 260 million. I think almost 100 million is our money, the 2 partners. The rest is third-party LPs, which are mostly strategics, meaning companies that are marketplaces that are interested in learning what's going on in the US and potentially acquiring some of the companies in the portfolio.
Right, and how do you think about and approach market sizing today? Like, do you think it's important when you analyze investments?
So total addressable market size matters, but not as much as you might think, because in a smaller market, you're usually in a position to dominate the category. And in so doing, especially if you create a much better user experience, you can usually increase the category, number 1. Or 2, you dominate it and then use that position to go in a conjoint category. And so as long as your core market is a few $1 billion, it's fine. It's big enough. And so we don't worry too much. It doesn't need to be $100 billion market. You can still build a massive business as long as you dominate that, and then you go in a conjoint category or conjoint geography.
Right, and you've been part of companies like you've been invested in a lot of companies. Some of the best CEOs recruit the best talent to the team, and what is the advice would you give to CEOs on how to recruit the second level of leadership team? And is there anyone in your portfolio which comes into your mind who's done a great job out of it?
So there's a question of like hiring the best people, and usually these are functional experts, right? So you're getting the best CFO or VP finance, you're going to get the best COO to help you with operations, you're going to get that CMO, and the best time to bring them on board. And also the different people, you need to learn, either they need to scale or you need to think through how to evolve. So because often your first lead engineer, he may be great for the first 10, 15 engineers. He may not be great once you have 50 or 100. Usually we try to have a fully robust management team by the Series V. Guy I think has done a really good job at building an amazing team is Charles Gora from Rebag, which is a handbag marketplace where I think every single sector or segment, from PR to marketing to managing offline stores to product, he's hired a superstar. And yeah, kind of into the Series B. You do it when it hurts, but not too late, right? Like I think getting a CFO or VP of finance on board reasonably early makes sense to help you do intelligent financial planning and to take a lot or offload a lot of the work that frankly as CEO you shouldn't be doing on an admin side, like on the fundraising side. I mean, you should be doing the pitches, but everything else in terms of like getting the deal docs done, et cetera, like is way better if you're not allocating your time to that.
Got it. And Fabrice, I quickly want to do the top three. I know you read a lot of books in a year, but do you have any favorite, a business book or a fiction or non-fiction book?
So yeah, to your point, I read a lot. I varies between 50 and 100 books a year. I don't like business books at large. I don't know. I find them kind of dumb and not very applicable for the most part. So I read both fiction, like a lot of sci-fi and fantasy, and frankly novels and historical fiction, and a lot of nonfiction, things like *Sapiens* or *Why We Sleep* or *Lifespan* or *How to Change Your Mind*, which I would all recommend. I actually have a book recommendation list, I think, on my blog, both fiction and nonfiction, that people can check out. I don't have like a favorite book. It's just like, what is the book that is that I've read recently that is the most meaningful. But I think in the non-fiction category, I'd say *Sapiens*, *Why We Sleep*, *Lifespan*, and *How to Change Your Mind* are probably the last few that I would recommend the most. Yeah.
Right, and when you started building OLX and other companies, startups that you've built, is there anything you would have done differently, or one thing you would have focused on?
Well, there are many things I would have done differently. My first company, I hired 20 gray-haired executives on the recommendation of my investors who didn't really understand the how tech was, and they wanted to build like consensus where you really need decisiveness. So how I recruit has changed profoundly. When I built OLX, I didn't realize I didn't know what SEO was, and SEO ultimately became a massive source of traffic for us. I think like 100 million uniques a month are coming from SEO, and I didn't even know it existed when I launched the company. So sometimes, yeah, no, there are many. Like I took the wrong investors for my first company. We weren't aligned in terms of vision or ambition, but I didn't realize that until after we were close to the investment. There are many things that would have changed. Now, the problem is with the information I had at the time, could I have made a better decision? I'm not sure. But yeah, I made infinite mistakes. I think what matters more is making a decision, evaluating objectively, and correcting course if need be. So be decisive, throw a lot of spaghetti on the wall, and iterate until you find the right answer.
Right, and do you have any favorite online tools, for example, Zoom, Slack?
Yeah, I mean, we've been working both distributed and remote forever, so this hasn't changed. This pandemic hasn't changed very much for us. We've been users of Zoom and Skype forever. We've been using cloud-based email tool, cloud-based emails and everything else. So we've been using Slack, Exchange / Outlook, and Zoom and Skype forever. And so I'm not sure I have a favorite per se, but clearly we wouldn't operate nearly as effectively as we do today if it wasn't for those tools.
Right, and what is the best way people can reach out to you and know more about FJ Labs?
ideally, you have people in common with me that could introduce you to me. If that's not the case, reach out on LinkedIn, and you can find more about me at my blog, fabricegrinda.com, and FGLabs at FGLabs.com.
Sure. Well, we'll put that in the show notes. Thank you so much for coming onto the show and speaking to us.
Thank you for having me.
Thanks for listening to the Life Self-Mastery Podcast, where we teach you how to start and grow your online business. For more information, visit Rohit's blog at www.lifeselfmastery.com.